Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Cheniere Energy stock so we can determine if it's a buy or a sell. Cheniere Energy is a liquefied natural gas company, hence the ticker LNG. It operates two natural gas liquefaction and export facilities, one in Louisiana at Sabine Pass and the other near Corpus Christi, Texas. LNG is a natural gas in liquid form. LNG is produced by purifying natural gas and cooling it to negative 260 degrees Fahrenheit to turn it into a liquid. This also makes it easier to transport as well. You can deliver a lot more LNG than natural gas in its original form. In 2015, Sharif Souki was the CEO, but ousted after a dispute with investor Carl Icahn. Souki now runs Tellurian, and the ticker for that company is TELL, T-E-L-L. Cheniere Energy is headquartered in Houston, Texas, and was founded in 1996. Let's get started with the model. This is a large cap company, 34 billion market cap. They're trading at 141 a share, and they have 244 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow looks amazing. It was negative 1.2 billion in 2019, way up to 8.7 billion in 2022. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that doubled from 1.2 billion to 2.6 billion. Even though they had negative 1.6 billion of net income in 2021, they generated positive free cash flow. So this definitely indicates they had lots of write-offs in 2021, which is why they had an accounting loss, not a cash loss. Revenue is a sales for the company, and it does not get much better than this, under 10 billion to well over 30 billion. They recently released their first quarter earnings, and this is their income statement. In the first quarter of 2023, revenue of 7.3 billion, down from 7.5 billion. Most of their revenue is in liquefied natural gas, 7.1 billion, down from 7.3 billion. Regasification is the process of turning LNG back to natural gas, and that was only 34 million. In cost of revenue, they had a gain of 1.5 billion. Last year, they had an expense of 7.3 billion. This looks really odd. You wouldn't expect a gain in cost of revenue. It's not like your employees are going to pay you instead of you paying them, or your landlord is going to give you rent money instead of you paying them rent. So how can they possibly have a gain? In their earnings release, they mentioned cost of sales includes 4.7 billion of gains from changes in the fair value of commodity derivatives. And that's compared to a $3.4 billion loss in the first quarter of 2022. So that explains it, a gain on their commodity contracts, because they do a lot of hedging against natural gas and liquefied natural gas. So if it wasn't for that $4.7 billion gain, they should have reported 3.2 billion of expenses, which makes sense. I'd rather them not combine derivatives with cost of sales. I wish they separated it out like most companies. And if they didn't have a $3.4 billion loss in the first quarter of 2022, they would have had 3.9 billion in cost of revenue. If you're a little confused, hopefully when we look at a statement of cash flows, it makes more sense. They spent 444 million in operating and maintenance expenses, 100 million in SG&A, 300 million in depreciation. So they had an operating gain of 681 million. Last year they had an expense of 8 billion. So their operating income was 8 billion this quarter. Last year they had a loss of 600 million. They spent 300 million of interest on their debt, lower than last year of 350 million. So their net income is 6.4 billion compared to a net loss of 781 million. But that's why the income statement can be a little screwy. We'll go through the statement of cash flows, the operating cash flow section, and that's what you should focus on, not the income statement. And it's good to see they have less shares outstanding, so they're buying back stock. They had 254 million shares outstanding last year, and now it's 244 million. This is the operating section on their statement of cash flows. And this is a much better indicator of how the company's doing. You should always follow the cash. And the way you calculate operating cash flow, you start your net income or net loss, That was 6.4 billion. Then we have to add or subtract the non-cash items on the income statement. We add back depreciation and amortization of 300 million. That's a non-cash item that brings down your net income, but we add it back here. Then we have to adjust for derivatives. We have to minus out 4.6 billion. Last year we have to add 3.6 billion because last year we reported a loss on derivatives, so that's why we add it back here. Then we have to adjust for changes in working capital. They had a cash inflow of 1 billion from accounts receivables, so that means that customers are paying them. Last year they had a cash outflow, so it looks like they extended credit, but not too much, only 16 million. They had an outflow of 1.3 billion accounts payable, so maybe in a prior year they purchased a lot of stuff on credit, which is a cash inflow, but now they're paying it back, so it's a cash outflow. Even though they had an accounting profit of 6.4 billion, they only generated 3.4 billion of cash flow. Last year an accounting loss of 800 million, but they generated 2.7 billion of cash flow. Usually operating cash flow is much smoother than net income. Net income can be really bumpy due to a lot of non-cash items, like depreciation, write-downs, and in this case, derivatives. Let's look at the capital structure. Negative 3 billion of equity, 28 billion of debt. So there's 0% equity, 100% debt. Their net debt is 26.6 billion. So that means they have 1.35 billion of cash on their balance sheet. I gave them a WACC of 10.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 64 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $57 billion. We divide that by 244 million shares. And we get a calculated stock price of $235. They're trading at $141, so they're trading at a 40% discount. It's a strong buy according to the model. Simply Wall Street has them at $105. They say the stock is 34% overvalued. 12 analysts price this stock, and the average price target is $202. The low is $173, the high is $233. 20 analysts price this stock, and the average price target is $198. They say the stock is 41% undervalued. This is where the stock has been trading historically. So you can see it had really low lows. Up through 2003, the stock was trading really low. They did 3 stock splits, probably reverse stock splits, so they wouldn't get delisted. Then it traded between $30 and $40 from 2005 to 2008. Then a Great Recession hit, and the stock came way back down to where it was pre-2005. Then it had a really nice run-up to about $85 in 2014. Then in 2016, it came down to below $25. Then it ran up to about $65, $70. Then COVID hit. It came back down to $35. And then it went to the moon. It looks like it maxed out at $190. And it's not that much lower than its all-time high. So the stock has done amazing since COVID. And you can see they started paying a dividend at the end of 2021. I'll show you that in the next slide. In the past 5 years, this stock is up 125%. The yellow line is Brent crude, and the red line is West Texas Intermediate. And both are down 4%. So this stock is killing those stocks. You can see they're really correlated, especially from 2018 to 2022. They were extremely correlated. But there are similarities even after 2022. But this stock just shot up mid-2022, and it really hasn't come down that much. They started paying a quarterly dividend in November 2021 of 33 cents. They raised it to 40 cents in November 2022. It's not a big yield, 1.1%, only 4% of their free cash flow, 15% of their net income. So they're likely to raise that dividend. There are 52 companies in the same industry as Cheniere, and if Cheniere has a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 2.4 billion, a lot more than the median and average. We cannot look at their debt to equity ratio since they have negative equity. When a company has negative equity, that means their liabilities are higher than their assets. They pay a really tiny dividend, only 1.1%. They generate lots of free cash flow, the most on this list. They rank 7th in market cap, 34 billion. The average is 10 billion. We can't look at their price to book since they have negative equity. Their PE is a little worse than the median and average, but amazing price to free cash flow, 4.0. and a really good price of sales of 1.0. When a company has a price of sales of 1.0, that means their revenue is pretty much the same as their market cap. You see annual revenue 33.4 billion, market cap 34.4 billion. So their price of sales is above 1.0 since their market cap is higher than their revenue. So it's probably like 1.02. It rounds to 1.0. And their 5-year annual revenue growth rate is amazing at 38%, much better than the top few companies on this list. To summarize, I have them trading at a 40% discount. The company has been around 27 years. And at one point, Sharif Suki was the highest paid CEO in the world. And they're not that big of a company. They're not like a Walmart or Apple to have the highest compensation out of all the CEOs. So that's a big expense they removed from their income statement. And they're hitting on all cylinders. Look at their growth in 2022 compared to 2021. Things are looking up for this company. I ranked their free cash flows and revenue 9 out of 10 and a ratio 7 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you want to become a member, you click on the link in the description below. Thanks for watching.